Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets. Yeah, of course they don't make any sense, and how can they when you have investors and computer algorithms and speculators bidding U.S. stocks higher because they think the coronavirus isn't a big deal? You know, the world's largest exporter, or about half of them, the nation, is on lockdown. Factories are closed and things aren't being done. And yet, Americans just don't think it's a big deal. They think there's going to be a huge V-shaped recovery. The economy is going to shooting way up the moment all these people get back to work because they're dying to spend. Yet, what most people don't realize is many people in China do not have infinite amount of vacation and sick time, and employers do not have an infinite amount of money. And you will soon start reading about how people are not going to be getting paid their full wage or any wage because there isn't any money when your factory is closed. And that is what is to come. You know, my wife asked me last night, she goes, why is it that you seem to know more about this stuff, but I'm not seeing it in the mainstream media? It's like, well, because you got to go look where it is. And you have to understand, why isn't the coronavirus being made a big deal of in the United States? It's real simple. We're at the end of the food chain in terms of consumption, right? If you look at the entire world, where does everything mostly come? Here, right? And we consume it, buy it, use it, throw it away, whatever it is we do with it. We are the consumers of the world. And the U.S. economy, 70% of it is the U.S. consumer. Now imagine if we saw more articles in the mainstream media about the coronavirus, TV articles, radio, pieces on, just more news about, hey, this thing's pretty serious. This thing could get out of control. This thing's having supply chain effects. This could cause debt defaults. This could cause further supply chain shutdown in other nations. What would Americans do? Do you think they'd go out and spend more money? Nope. They do just the opposite. They would stop spending money. And when the world's largest consumer decides they've had enough, there goes the rest of the world. So in a sense, the American consumer doesn't need to know what's going on. In fact, hopefully they never find out that, yes, we're sorry, there's a short of iPod Air, I don't know what the wireless Apple headphones are, or earbuds are called, because the factory is shut down. And don't worry about that. That's a minor issue. I'm sure it's just a shipment that's in delay, but we'll have them soon. And don't worry, I'm sure we'll throw in some free stuff on top of that just to make sure you're happy. But the reality is this has a serious ramification on supply chains. And ultimately, that will get over to here. And when supply chains here, factories here in the United States start to close, if that isn't fixed over there soon enough, then there's problems. We've already heard about auto plants closing in South Korea, Russia. We're hearing India talk about if we don't get more smartphone parts, we're shutting down our factories. This is serious stuff. But Americans don't care because we don't see it, right? As long as we go to the store and see, hey, what we want is there, we're cool. Imagine going to the store and not seeing that stuff. Taking your car in to get serviced. Remember when General Motors was on strike and people took their cars in and could not get service? Wait till more of that starts happening. When you can't get parts or major supply chains are shut down because one specialized screw at one specific factory is made in China and it can't be delivered. Serious stuff. And you're also talking about, the crude oil inventory, which normally would have today, but because of the holiday, there's going to be a backup of supply chains all around the world. But as long as Americans keep spending, and that's really key, as long as Americans keep spending long enough to get through this, maybe it isn't that bad. But if it keeps going on and Americans figure it out, watch out. Let's take a look at the NASI, the NASDAQ McClellan Summation Index, the proxy for liquidity. Gosh, no video on Monday, and you think I'm a rookie doing this again. So you see, even as the market keeps pushing higher, liquidity is getting tighter. And why might that be? Well, we could look at the bond market, and we will today. Let's take a look at how hedge funds are positioned thanks to Hedgeopia. Now, this will be delayed on Monday. Next Monday's video, we won't have this because of the shortened week, but we'll have it on Wednesday. But let's take a look at 10-year treasury yields. Now, mind you, this was as of Tuesday last week, hedge fund managers, knowing what is going on in China, increased their net short. They think there's inflation coming and higher interest rates. And what happened? Interest rates went down, and these positions are money losers because you can see they increased their short position as yields were going higher. And then boom, what happened? All these positions right here are now net loss. What is surprising to me is they actually backed off their 30-year positions, which may be the reason why we saw this big decline in yields, because perhaps they got stopped out, meaning they had positions. So you can see right here, they were very short the 30-year treasury right at just under 2.4, around 2.3%, 2.2, somewhere right in here. And look, yields went down. They probably got stopped out, and those positions were unwound. And that helped move yields on 30-year down, which drug 10-year down. But they still increased their shorts on the 10-year. And this is great news. If you own bonds right now, this is the best news, because let's take a look at, here, sorry for moving around too fast. Let's look at 30 years. The last time 30 years they were in a major bottom, boom, speculators were long. So here we are flirting just around 2%. The all-time low is just over 1.9. And specs are still net short the 30-year, still net short the 10-year. So what is that telling you? That yields are going much, much, much lower. Only part of the reason due to speculators. So that's great news. Take a look at oil. We're seeing speculators. They're still holding the dream that crude oil is going up in price. Again, I find this pretty interesting because cargo tankers going into China are being diverted. I mean, production in China is really low. The only question is, the longer China stays offline, the more this inventory builds up, and it's already fairly high to begin with. I don't know where it goes from there. S&P 500 futures backed off slightly. We don't really need to worry about the euro. Gold, still very long gold. I mean, we're still sitting near the the all-time high in terms of speculative positioning in gold. People still think gold rips higher. I think gold rips lower mainly due to the speculative positioning alone. I think it's propping it up. That is your buy point. The next time this comes down, that's where you find where the base is of the smart money. That's where you look to buy that. They're backing off NASDAQ, which is interesting as the NASDAQ goes higher. Again, all you're seeing is 80% of this market is computer algorithm traded. It's just literally buying because yesterday the market was up, the week before, the month before, 2 years before. It's all it's telling them to do is buy, buy, buy. And they backed off their Russell shorts as the Russell went up. Our longs, it's just hedge funds are struggling as much as any active managers are right now. But they did get the dollar right a little bit. Dollar is tearing higher. I think the dollar's got a long ways to go up here, and it's going to bring treasury yields down with it, and that will bring volatility up. And speaking of volatility, they are still very, very short volatility, and this is just an eventual powder keg waiting to burst, especially when you look at the overall positioning. Now, I also want to look at major foreign holders of treasury securities. This comes out once a month, and we saw that foreign investors, these are major foreigners. These are not, individual positions. These are large, mainly central banks, hedge funds, and things of that nature. Decreased about 44 billion. Say, well, that's really bad. Doesn't that drive interest rates up? Well, the answer is not exactly. What you see in that chart is what I've been writing about and talking about with world dollar liquidity. So what do foreign central banks do? They accumulate dollars, right, through global trade. So when trade is booming, they're getting more dollars. And so when they get those dollars, what do? They buy U.S. Treasury securities. Now, when they're short those dollars, right? Now, why you say, well, why would they be short? Well, because perhaps people in their country and businesses in their country borrowed in dollars. And you say, well, that doesn't make sense, right? Because we don't think as Americans are going out and borrowing in renminbi or euro or anything like that. We don't do that. But as the world's reserve currency, other people do. So if you're a business in another country, you can absolutely borrow in dollars. There's no problem with that. You can do that. So if you have a dollar-denominated debt and global trade slows down, and there's the largest contraction in world dollar liquidity or destruction of dollars in the history of the dollar being the reserve currency, what might you need? Well, you might need dollars. Well, how would you get them? Well, you would exchange your local currency, say renminbi or yuan, for dollars. And what happens is that puts demand on dollars to go up. That's why we're seeing the price rise. But what does it mean from a foreign central bank perspective? All of a sudden, they're getting calls from the local banks in that, I don't mean local to the community, local to the country, saying, hey, I need some dollars, and I've got some local currency that I need to exchange. And the central banks are like, hey, I don't have a lot of spare dollars to hand you. So what would they do? They're going to sell Treasury securities. They say, well, wouldn't that drive interest rates up? Not when financial conditions are tight. When financial conditions are loose, it would, but not when they're tight. It doesn't work like everyone thinks when financial conditions are tight. And who's mopping up the other end of this? Well, the Federal Reserve, buying $60 billion per month. So here we see they sold $44 billion. The Fed mopped up $60 billion plus. They're doing massive, they've got $200 to $300 billion of various dollar repo programs or lending programs they're doing. So the Fed's mopping this up. So when you see foreign central banks selling Treasury securities when financial conditions are tight, it makes sense. And all it does is validate there's a shortage of dollars. It means dollars goes up, interest rates go down because we need the system to create more dollars. How do we create dollars? Through lending. You got it. Okay, let's go on and take a look at some charts and see. We can look at some tail risk here on the VIX. If we go out 2 years, we can see why these computer programs are buying, because VIX is in this downward trend. So they're going to over leverage themselves, which will be ridiculous at some point when they have to go the opposite direction. But for the moment, that's what they're doing. So 10-year Treasury yields, let's extend this line out a little bit. So we can see it broke this line, and then the market tried to confirm the bottom side of it. Very normal move of the market trying to say, hey, we broke through this diagonal support level. We're trying to come back up to find out if anyone right in here are sellers. Because remember, yields rise when people sell bonds. So is anybody sellers? And the market's saying, not really. Why is that? Because they sold through here and they sold in here and they're upside down and they're not looking like they're wanting to add to those positions. So this is a good sign. It's retesting the upper end of the support line, and that suggests that, again, yields are likely to head lower. If we look at 30-year yields, they are not retesting, but they don't need to, because obviously 10 years are doing it for them. 30-year yields are saying, look, we're right near our all-time low at 1.9. Based on the economic data that came out today, it says they should be somewhere at 1.5, and that's before any repositioning of all this money in equities gets pushed back into something, back into bonds. Let's take a look at the ETFs. Let's see how we're doing on time here. Here's TLT, the largest long-term bond ETF. And let's take a look at this. So we came down price-wise. It hit support here and confirmed. It said, hey, do any of you who are sellers here want to sell? Nope. Okay, it went up and it found sellers from here and over in here. And these sellers came down. The hand wasn't very strong. Didn't have a lot of ammunition. Came down right into here and went up. And what did we find out yesterday? Well, there were still some sellers here, because we can zoom in on this, and I'll zoom it in a little bit further, or maybe we won't. Let's try. All right. Well, whoa, that's fun. That would make looking at charts interesting when your connection to the chart server decides to go down. So anyways, what we're seeing in the long-term bond on TLT is it confirmed that overhead resistance. And if we looked at the overnight, it touched it. It came down and touched it again. It's knocking at the door saying, hey, I'm going to break through here. And so what did we see today? We saw, or say yesterday, oh, there goes the chart. So what did we see yesterday? Here you see an overnight. Here's yesterday. It came up and sellers came in. What was this move here? This was the Fed buying Treasury notes. Then we see sellers come in and say, "Now we got to keep this thing under wraps." And what? Overnight knocked on the door, and then overnight selling down, and then today, it dipped in early trading, and then buyers came in and pretty much largely unchanged on the day. But what it's setting up is this big, massive move higher, because here's your all-time high, here's your bull market breakout out of these structures, and this thing's got nothing. Oh, you know what? It probably would help if I actually showed you the charts, wouldn't it? So here you see, sorry about that. Here's the Fed buying notes. Here's the market selling it down. After it hit resistance, sellers come in and say, no, we don't want to let this cat out of the bag because we'll be in big trouble. Then overnight, it tagged support. You see a little green dot, and then it got sold off again because, again, they can't let this thing break through, or else now there's a major unwind. And then today, it dipped in early trading, and then buyers came in and kept it up here. So what we found out is it held support right here at that prior high. So saying, hey, the people that sold here, not that interested. And all this is setting up is that big move higher to break out of this consolidation pattern and the second consolidation pattern into what will likely be the biggest bull market in bonds you've ever seen. Because not only do we have a net short positioning from the speculative standpoint, but you have 80% of the market traded by computer models who owns a very small amount in terms of percentage holdings of bonds than they ever have. And wait till those computer models flip back and have to buy bonds. This whole China shutdown thing kind of adds to the narrative that deflation's coming. I'm Steve Van Metre. We'll see you Friday for our longer weekly economic update. The content of this video is provides educational information only. It's not intended to provide investor and other advice. Sales not to be construed as recommendation or solicitation by selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Own person has capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.